The question that I did not see via email before I jumped on the webinar, William just resent to me through our question pod here. And William says, should I be trading more verticals and less Iron Condors? Since November, the market has gone virtually straight up. Now in the last month, last 2 weeks, really, I leave on vacation for a week and the market goes to pot. I'm sorry, you guys could blame me for that. It must be that, really. Anyway, finding that makes Iron Condors difficult. Exactly. I'm finding that over a fairly large sample, I'm keeping only 25% of the initial premium received. And I noticed that my vertical spreads given the right direction, I'm keeping 50%. So while the net income is similar, I'm still better off trading verticals compared to Iron Condors because there's less angst, less management needed. And he says, is that roughly the results you get or the results I should be looking for? And, that was part of his other follow-up there that he had mentioned. That was the first thing he sent, but I didn't see his initial email. It says, further, my email trading verticals requires fewer adjustments and has less commissions. Yes. Okay. Now, you've all heard me discuss this before. Okay. Let's just see if we can come up with something here in the search, a basic Iron Condor. Now, what we're going to do here, William, is going to look at a few things. And I don't want to use the SPX as just an example. I'm just going to go to a default stock, and we're going to take a look. Snowflake is probably a good one to use. Broadcom, I know they took a big hit before this, actually. They took a big hit. CrowdStrike did too. Dell is more of a soft mover. So let's go ahead and take a look at Dell, just in general. First, we'll take a look at what is an Iron Condor. Well, the Iron Condor, of course, is a combination of the two vertical credit spreads, a bull put credit and a bear call credit. And, there we go. I wanted to get on the graph. I wasn't on the graph. Sorry, guys. All right, now, in general, what we're going to do is just as we would in a position I was neutral to bullish on, and I wanted a good leveraged return with a high probability of success, I would do a bull put credit spread. I'd sell an out of the money put. So with Dell currently at 115, it looks like we're selling maybe the 95 or the 92.50 call. Okay, I'm sorry, we're selling 95 put and buying the 85. Initial net credit on this one would roughly be about 37 cents. We're going to collect 50 cents for the short put, pay $12.50, $13 for the 85, so we collect 37 cents in. Now on the same side, I'd go almost the same distance away. And I'm going to sell a 130 call closer to the stock price and buy a higher strike 140. So I'm combining the bull put credit spread and the bear call credit spread on the same underlying security. In the bullish markets that we saw, going from November, for example, beginning of December through roughly mid-March, with some foible or two in there, primarily I was just trading bull put credit spreads. And I know you don't probably have the time to do this, but if you go back over the years, William, and you scan YouTube videos for Iron Condors, and you go back over the years previous to certain years, you'd hear me say that I haven't traded Iron Condors in about 10 or 15 years. I started looking more into bull put credit spreads right around the end of 2016, beginning of 2017, trying to formulate a game plan, my preferred structure, lack of a better term, for bull put credit spreads. And I consistently stayed with that and managing just those because the markets didn't seem like they were conducive to doing Iron Condors. We had some strong bull runs, as you know, going into 2018 and 2019. In 2020, we all know what happened there. And in the end of 2020, we all know what happened there. 2021 was a melt-up year. We'll take a look at that in a moment. That was the prime time to be doing Iron Condors. What we mean in a melt-up is that essentially we were seeing movements up of about 1 to 2% in the broad-based indexes every 2 to 3 weeks, and then a little give back of about 0.6 or 0.7% in a 4-day period. Then about 3 to 4 weeks moving up of 2 to 3%, and then a 0.4 or 0.5% give back over the next 10 days. That was the perfect time to double up on the premium, do the Iron Condors. But just about every other year prior to that, well, 2020, exactly what was going on there. But even those other years prior to that and the years after that, with the movements and the fluctuations we saw in the market, it was going too bullish or it was going too bearish. You're managing one side or the other of the Iron Condor. In other words, I do appreciate your point, and I do agree with your point. Iron Condors, except for something on a very, very broad-based index and even shorter term, are very risky with as much volatility as has been in the market, and volatility has been increasing recently. When I see volatility go to the bottom, I'm usually looking to start to look at bear calls or things of that nature, or buy calls on the VIX as an extra hedge across the portfolio. As profitable as these seem, why get only one credit of 37 cents for doing bull put credits, or getting a credit of almost 90 cents here on the bear call when I can double it or increase it by 25, 27, 50% by doing both legs? And it's because very rarely, at least in the last 5 to 10 years, have we seen a market that's conducive to neutral, low volatility, neutral, unconcerned about economic factors, unconcerned about news, unconcerned about elections, unconcerned about global conflicts. We haven't seen it except for that one instance when it was the prime time to be doing those types of trades. It had always been better to go with a more vertical direction, bullish or bearish. And, of course, using the vertical spreads to pick that direction. You can even use the debit spreads as well. I think is a better approach. Proper market conditions, proper direction. You said trading verticals requires fewer adjustments. Well, that's not necessarily true, because the market can shift on you quickly. The black swan event's unknown, so you're going to have to manage the bull put side just as much as you'd be managing the Iron Condors, as all maybe 4 or 5 in your portfolio start to go against you. And on the other side, increased optimism that started to come out of nowhere in December with, as Robert mentioned, the ideas of economy is great, market strong, jobless claims are down, jobs are increasing, everything along those lines. And we got this extreme investor optimism from about December 10th, really through all of January into February before things started to calm down. And now, of course, we're giving back a little bit. Of course, we're also seeing some earnings coming out recently that didn't quite meet expectations that people were expecting. And that's and hesitation. All the reports, even if they beat, they're coming out with concepts of, but we don't know about next quarter yet. We don't know how much the costs are going to affect us next quarter, because we did all this planning and all this cost cutting going into this quarter. We can't cut much more. And we still have inflated costs for shipping, processing, that kind of thing. So, yeah, the further quarterly discussions aren't looking too rosy for a lot of things right now. Some are, some aren't. And that's had its effect too, William. All right. But all that being said, let's just go back to SPX real quick, and let's just take a look at what I was referring to. Let's just go to big charts. We know what's happened in the past 2 weeks. Again, that's when roughly I started my vacation, was right around the 9th here. So you can blame me all for that. I leave, I go away from the desk, I go to see the eclipse, and then we go take another little vacation with the family, and this is what happens when I'm gone. So that's clearly my fault. But let's just go the last year to date, just to January. And this, illustrates your point. Even in SPX, going even short term, weekly, daily, daily might have been a little better, but that gets confusing and that adds more angst because you're trading much more often. But this type of movement from 47.50 up to 52.50 in this short of a time span, you're doing a neutral position and you're sort of standing in the way of the freight train. Even if I'm selecting Iron Condors, short Strangles, or even the bear call credit spreads that have an 80 to 85% probability, some of these large gaps up. Okay, here's a hiccup down, right? You could almost say this is sort of a melt up with a little correction here, melt up, but this was really, really strong. But that's just year to date. To your point, we go back 12 months. That right there, think again, I know I'm being hindsight 2020. I'm being Captain Obvious here. But that kind of trend is not where we want to have anything on this bearish side, even with 80, 85, 90, 95% probabilities. There was too much optimism to the upside, and there's too much movement going in that direction. This was a better time to be using bull put credit spreads, bull call debit spreads. Even bear call credit spreads would have been extraordinarily tough to do this as well. And you say Tasty Trade swears by the Strangle trade. Well, I'm not going to discount that. I'm not. I'm sorry, Will. What I'm saying is I'm not going to discount someone else's teachings. They might have a structure that they use for the short strangle. I personally would never trade a short strangle. That's because I was taught by Ernie. Ernie's very risk adverse. Okay, even if this was only 1 or 2% of my portfolio, the chances for large negative losses and margin requirement on the naked short side of the put or the naked short side of the call could be too much. Maybe I would do this on SPX. I doubt I would do it on NDX the way that that's been moving, especially with the AI boom and everything along those lines, William. It just isn't my preference. I don't even look into it. I don't even try to find the best short strangle trade on powers. We've got criteria set for defaults that we prefer, but I don't go back and test them. I don't trade them because it's not something that I'm really interested in doing. I'll walk any investor through any of the search tools we have to try to find the probability between, the probability sum, ranges out of the money, all the criteria that we have to try to help them find the best short strangle. But I'm never going to trade one in my personal account, honestly. I'll trade an Iron Condor. I have traded them, William. I will trade them. But during the market over the last 5 or 6 years, I was doing bull put credits. Well, actually, now we're about 7 years, 7.5, 8 years almost. Let's just go back 5 years. Despite the fact of 2020, you look at this, do any of these time periods scream out to you? And I know it's condensed. We're talking about 5 to 6 to 8 months at a time. This was when the market sentiment had us going 2022. Remember that? Remember how bad that one was with the volatility? I was rarely doing bull put credit spreads during 2022 or bear calls, to tell you the truth. There's just too much going on. Then we start coming back in 2023, little hiccups. This might have been an okay time for Iron Condors. This probably wasn't. This is more bear call credit spreads. This is definitely strong bull put credit spreads. Not neutral positions. Not Iron Condors. And I think, what was that, Doug's question here? I'm not sure if I'm reading this right, but I'm wondering if you mean, does this rules apply to butterfly trades? I'm concerned about all neutral positions with this type of market. And now we've had this quick give back. So here on the Iron Condors, you can see you've been managing the bear call side. The bear call side, as you said, William, you've been making 25% of the full credit because it's costing you more to manage the bear call. And then boom, the last 10 days, you've been managing the bull put side as it's been going against you. And I think you'd have the same effect with the Strangle, only because I think you'd be looking for the same probability. It's 75, 80, 85% probability that the stock will be below the short call or above the short put strike price. Okay? I get the idea of the short strangle being profitable. Let me tell you a story. Okay, very quickly, sidebar here. Years and years ago, we had a gentleman who was taking a trial of power options, and he wanted to do short strangles. And he called up Ernie he called up me actually, I believe, first, William, for a coaching session. And the short strangle is just selling an out of the money put and an out of the money call, no protection on either side, like we have with the Iron Condor position, because you have those outside wings. You lower the net credit, you lower the max return, but you have a known risk, not a low risk. Having a low risk is up to you, but you have a known risk on the spread position. You don't know what could happen here. Anyway, gentleman says he wants to turn his $42,000 account. He thinks he's going to be able to turn it into $1 million in less than a year by trading only short strangle positions. I try to warn him of that. And I said, that's beyond expectations. I don't think you want to do the strangles that you're looking for. I think they're too close to the prices. You think you need a little bit more oomph. You need a little bit more out of the money, a little bit better probability in these situations. So one thing we do offer here at Power Options is a performance guarantee. We're traders ourselves, and we know that things that work for 5, 6, 7 months in a row might not work in the next 10 to 15 days because markets change. Well, after the first 30 days, gentleman called up and asked for the guarantee. He wasn't making any money. In fact, he'd lost about 32%, I think, the first time of his portfolio trading the short strangle positions that he said he wanted to trade, and we helped him set up. So we said, well, we don't think what you're doing is going to be profitable. We'd like you to schedule another session. This one he had with Ernie. Ernie walked him through the same thing, said he should be going further out of the money. He should be looking for less return. And it might be better to do an Iron Condor, and he should only be using probably 10 or 15% of his portfolio for Iron Condors or short strangles, things that can hit 100% loss or higher against the net credit in the case of a short strangle in black swan events or large upward movements. He said, okay, yeah, I'll think about that. Calls up the next month, asks for the performance guarantee again. If you don't make 5 times, your subscription account, we'll give you the next month free, but we want to get involved. Scheduled another session with him. He's down over 50% already. Swore he was going to make money on short strangles. He's going to make it back. He just had 2 bad months, and the months weren't really that bad. We iterated our position, told him he should be looking at different strategies or at least using higher probabilities because clearly this wasn't working when he was doing. He said, thank you for the advice. I'll try to change my criteria. Calls back the next month, didn't change his criteria. He's now down about 70% of what he started with the $42,000. At this point, Ernie was just honest with him. Said, you're not going to listen to us. We're not making any money from you using our tools and taking up our time with these discussions because you won't listen to us. So I'm going to ask you to just cancel your account and good luck to you. Happy trading. Because there was nothing he could do, but he lost about 75% of his portfolio in 3 months with short strangles. I forget what year it was. It was probably one of these years, or maybe even something like that. It was after 2008, 2009. I remember that. It could have been around 2012, 2013. But people are lured by the short strangle against the Iron Condor because you're getting more premium. That also means you have more defined risk. Why I'm going into this sidebar here, William, is because, like I said, I haven't studied the short strangles positions, and I don't trade them personally. In market conditions that we've had recently, I've seen enough investors have bad luck with Iron Condors, even with the good probabilities, that 80-85% probability between, where the either leg of the credit spread, bear call or bull put, had a probability of 80 to 85% below the short call, William, or above the short put. Because the market conditions were favorable to more of a direction, or was too volatile to be doing really credit spreads, even though it's attractive because volatility is higher. We're getting more bang for the buck, absolutely, but we're taking on more inherent risk. If Tasty Trade is swearing by them, then it's because they've put a lot of detailed research and analysis into specifically what types of securities they're looking for at any given time that I haven't put into it because I don't follow that strategy too much and I don't advise using it. If you want to use it, I'll show you how to use the tools to set it up. But at the same time, they probably have distinctive features that they have set up for management techniques of the short strangle, adjustments that they want to use, adjustments they prefer to use, just like I have for the bull put credit spreads. In addition to developing the criteria and the structure and the timing that I wanted to use, both for the underlying security and for the options for the bull put credit spreads, we also developed 8 ways to manage the bull put credit spread. And I'm sure they have similar places in mind to keep risk low, keep exposure low on their short strangle positions. And I wouldn't even know where to begin with that. So we all have our different approaches to it. And that's why I'm saying I can't say anything bad of what they've done, because they've probably done a ton of research and infinite more trades in the short strangle position than I've had, because I've never traded one. I only trade Iron Condors.